Okay, class, welcome back to the final section, part 4, which is going to be about goodwill as a specific intangible asset. So you can see the notes here. Goodwill is recognized and recorded when it is produced externally, meaning it's not because as a company we say from an internal basis, oh, you know, our customers are worth X amount of money, or our organization is worth X amount of money. Externally means right here when one corporation acquires another corporation and it pays more than the quote net assets of that acquired corporation. You can see right here, net assets is defined as assets minus liabilities. And what you have to keep in mind when we're talking about goodwill here is assets, when they're acquired, when we're buying this other company, are recognized at their fair market value at the time we purchase those. So we have to make some adjustments. So by way of example, I'm going to do exercise 12-12 on page 683 out of the textbook. So you can see for yourself that what we have here is a balance sheet of Ziefel Galleries, which is being acquired by another company. The other company is Moss Interiors. And you can see the list of assets, the liabilities, and then common stock, retained earnings to round out the balance sheet. So what's going to happen is Moss is going to acquire those assets and recognize those assets at their fair market value. And we can see the information below says that land is undervalued by $30,000. So that means for us that the fair market value of the land, which is on the books now of Ziefel at $70,000, is going to be brought on to Moss's books at $100,000 because it's undervalued by $30,000. So that $30,000 plus the $70,000 is on the books for $100,000. And the equipment, which is on the books at $175,000, we're told is overvalued, meaning someone went out, praised it, and it's determined that the fair market value of the equipment then should be $170,000. Okay, so when we take the $575,000 of total assets on the books, add an additional $30,000 to bring the land up to fair market value, subtract or minus $5,000 for the equipment that's overvalued. That means that total assets at fair market value will then equal $600,000. If we take the total fair market value of the assets, which is $600,000, less any liabilities that are being purchased. In this case, the liabilities are $50,000 in accounts payable plus $300,000 in a note payable, which equals total liabilities of $350,000. Therefore, the net assets acquired which is the fair market value of the assets less any liabilities, the net assets acquired is $250,000. That's the fair market value of the assets at $600,000 less the liabilities of $300,000 equals $250,000. That's how I got that number. And when I compare the net assets to the purchase price, it will equal goodwill of $100,000. In other words, the excess purchase price paid, which we're told was $350,000, less the net assets, which was $250,000, equals goodwill of $100,000. As I mentioned at the very beginning, externally generated goodwill means when a corporation purchases another corporation for more than the net assets of that acquired corporation. Just have to remember that the assets, when acquired, are recognized at fair market value. Okay, so we have used the fair market value of whatever it is that we're purchasing, taking the assets, total fair market value of the assets, less the liabilities that we're also acquiring to figure out the net assets acquired, which is $250,000. Compared the net assets to the purchase price, which we're told was $350,000, and therefore calculated the leftover, in this case $100,000, and that will equal goodwill. As we said right here, the excess purchase price over the net assets is considered to be goodwill. Okay, so how do we record the acquisition on the acquiring company's books? By the way, Moss Interior is the acquiring company. So we're going to bring all the assets on at their fair market value. You can see for yourself right here, there's cash, land now at $100,000, not $70,000, because the fair market value was undervalued by $30,000. Buildings, $200,000. Equipment now at $170,000. Copyrights, $30,000. Taking into account, we're also acquiring the liabilities, accounts payable and notes payable, and we're paying $350,000 to do it. And so therefore, what makes the whole entry balance is the recognition of another asset on our books that's going to be called goodwill. Okay, so that's how goodwill is calculated, purchase price over net assets. That's how the whole acquisition would be recorded, bringing everything on at fair market value, the difference being goodwill. And of course, recognizing, how much we're paying for this acquiring of this corporation. By the way, for what it's worth, this method is referred to as the master valuation approach. All that means basically is that we're valuing everything we're purchasing, and what is left over is goodwill. Okay, so that ends this lecture on intangible assets. So I want to call your attention. I'm going to come back to this piece for take-home exam number 3, which is worth 20 points. The first 3 questions we have talked about, first 4 questions actually we've talked about already, which is an example of recording an intangible asset, then calculating, recording amortization expense, telling me a little something about the difference between tangible and intangible assets, and giving me some examples. Part 5 then is based on goodwill, based on these notes we just talked about, and I've asked you to complete exercise 12-13. As you can see for yourself, that's out of page 684 in your textbook. I've asked you to complete the instructions for that. There's part A and part B, all to be turned in with your take-home exam, and it'll be worth 20 points. So good luck with all that. If you have any questions, let me know. Otherwise, see you in class.